be amended with the falling power.
Thank you. Rushanara.
Well, thank you, Chair. As one of the MPs, among others, who asked you a lot of questions about Governor, about call-in powers, as well as the FCA, and there was collective agreement that this attempt at a power grab by the government would be damaging to independence and the international reputation of our regulators. And I'm glad that it has been dropped by the government. But there seems to be a bit of a pattern of an attempt to seize some of the powers of independence that the regulators have. And I just wanted to pick up on the Chair's questions in relation to Solvency II. Sam Woods, you just said earlier, reform packages as a whole increases its risks. Could you each of you talk through what that means? It seems quite something that the PRA's recommendations on reforms to the fundamental spreads hasn't been taken on board by the government. And it feels like if there is going to be there's clearly a big difference and concern about risk, that we're going to have to enter into yet another sort of dialogue between, as backbenchers, as committee members, with the government to try and get them to see sense, or is that not something we would need to do?
Well, I come back to that. It is a very broad package. There's a whole bunch of other stuff in it which we're very keen to get on with, and some of that is
specifics. My question was about this specific point you've made about reform packages as a whole increases its risks. And after we've had the mini budget fiasco, we've had an attempt by the government with the call-in power, which it's had to subsequently scrap because of the representations you've made on this committee and others have done about the risks to international credibility of our independent regulators. Can you answer this specific question that you've raised concerns about that the government is ignoring you on? What do you make of that?
I don't think the government has ignored it. They've just reached a different view. So the assessment, and again, the government should speak for themselves. I'm sure they do and will. But the assessment that I think the government was making was the level of weight that it wished to put on the growth part of this package. And it considered, taking into account evidence that it heard from us and also from the industry, which, as Andrew said, was in a very different place on this topic, that to advance with changes to the fundamental spread of the sort that we had outlined or things of that kind would, in the government's view, have frustrated the ability of the sector to invest at quite the level they wanted it to do. Now, whether or not that point is true cannot be conclusively proved one way or the other. The proof will be in the pudding. But
is there a risk to financial stability?
I don't think
we are very exercised by that, given what's happened recently with what Liz Truss and her government did. It's a serious issue. So.
I do not think that this particular set of reforms, notwithstanding a disagreement on this piece on it, is a major financial stability issue. I think it's much more of a policyholder protection issue. Because ultimately what will happen here, if it turns out that this was a problem, as I say, people can debate either side of it, that should have been addressed at this point rather than at some point later or not at all, then the way it comes home to roost is if there's not enough capital backing pensions. Now, you can look at history to give you a guide as to what is likely to happen if that occurs, and I would say it's highly likely that comes back to the public purse if that occurs. So, it's our job to think about such things and worry about them. But
what are you exactly saying then? It's a risk that we should be able to tolerate, or if it's a risk that if it becomes a problem, then it will cost the public. You're trying to. If I've not misunderstood this, you seem to be trying to have it both ways. I'm getting a straight answer.
Well, I'm trying to give you a straight answer if I can, but it is complicated because our position advanced within the scope of the statutory objectives of the PRA was for a package including all the elements that are currently in there, plus this one, reform to the fundamental spread, and we thought that was the right place to go, given our risk tolerance and the objectives of the PRA. The government has a wider and different set of objectives, and they've reached a different view on that one element. I think the effect of that will be to increase risk, not, as I say, to a huge degree, but I think it will increase risk as a net effect of the whole package. And I think the question for Parliament will be, does that seem like a reasonable trade-off that's been made? Do we support it or not?
You know what happened in the past, recent past, with the government taking a different stance to, what the bank has been doing, and how that can be damaging where the two are not working in concert and not aligned. Given that with the Edinburgh reform, I know other colleagues will come in on it later, but we've got ring fencing. There are quite a few things that are now happening. When you look at the sum of those things, as well as I'm going to come on to competitiveness as another dimension to regulation now, is there a risk that these things are going to go in different directions and then present a risk to financial stability?
So I think on the Edinburgh reforms, and colleagues may want to come into Andrew in particular, if you look at the package of things that was announced in December, I do not believe that there was any commitment made in that set of announcements which presents a significant risk to financial stability. But there are two things which are part of that package. You mentioned one of them, which is ring fencing, the other one is senior managers, where we're more at the beginning of a process than at the end of it. And I don't know if you want to go into those two, but in those two, I think there are areas where we want to be very closely engaged, because there are obviously things, at least in our view, that you could do with those regimes which could present such a risk. But those commitments haven't been made yet.
Okay. Governor.
Perhaps I could illustrate the issue just by going over to the LDI issue for a very brief moment. One of the issues we had the big issue we had in the LDI moment was that we had a movement in long gilt rates which was outside historical experience. Now the question always arises, we get it with banks, and we get it when we do stress testing of banks, we get it in the capital regime for banks. Where do you put the sort of, in a sense, the line down in terms of what level of risk you're protecting against with the regulatory system? And what is the backstop you have beyond that if something, frankly, out of the ordinary happens, or out of normal happens? And in a way, this debate about the fundamental spread is about saying, where do you want that line to be? And what is the consequence if we go, if, as Sam rightly says, you put it in a place where you're somewhat more likely to go beyond that line than if you obviously put it further out? Now, I agree with Sam. I don't think that it's likely, other things equal, that it's a risk to financial stability. It is a risk to policyholders. And to policyholders. And this has happened. I mean, bear in mind, this has policyholders, because we're talking about annuity policyholders here. And it has happened. I mean, I will mention Equitable Life. It has happened in this case. I mean, it can happen. Different period, different product, and, somewhat different product. So there has to be a choice. That choice is judgment. It's not subjective. You can't draw an objective line. And the backstop, and I think Sam's very important point Sam made a few minutes ago, the backstop, if we get something happens beyond that sort of line, is, first of all, it's the Financial Services Compensation Scheme, which is the industry scheme, and beyond that it is, I think, potentially the public purse. That's what we have to recognise.
So how big a risk is it to the public purse, this direction of travel that's going in the opposite direction of what you're proposing? I don't think
it is not a large increase. I think what we should do frankly, and as part of, as I mentioned earlier, this setting out of risk tolerance to Parliament, is do our best to frankly to calibrate that.
Yes, it would be good to have a bit more in calculate, that's calculated to this committee, because I think what the public will want to know is what the cost to the public is for this divergence. Do that, yes. Given this divergence that's going, that would be really valuable. Just turning to competitiveness, Dame Collett and Mr. Hall, do you see risk to financial stability as a result of the PRA and FCA's new remits and objectives having a greater emphasis on competitiveness?
Sorry, I missed the very end of that.
Greater
emphasis on
competitiveness.
Do we see risk to financial stability?
Yeah.
The short answer is no. But as you would probably expect from, maybe as you might expect from someone like me, there's a few caveats in there. I think it's extremely important that we have a focus on that for all the reasons everybody on this committee knows and understands. But I think in pursuing a competitiveness objective, you've got to be extremely careful to balance that with the ability of, let's say, new entrants to the market to be able to deliver to clients, be they households, be they businesses, of the banking sector. So I think, yes, it's right to pursue competitiveness, but you'd better have a bit of a careful weather eye on what's actually happening in the market and whether new entrants can actually deliver on what they say they're going to deliver, because if they can't, that's where you get your financial stability risk. And perhaps in a more diffuse way, that's where you get a risk to public confidence in the system, which is, of course, the raison d'etre of what we're doing here. It's about confidence in the system. Sorry, that's rather a lengthy and rambling answer, but I hope you can see
Mr. Hall,
where
did
I'm
you
going.
want to come in? Thank you, Dame Collett. Did you want to come in on that?
Yeah, of course. So, of course, this is to do with the PRA's objective, but and from our perspective, the question is it an issue for financial stability? But of course, we ourselves have a secondary objective as well. So our primary objective is financial stability, and our secondary objective is to support the government's productive growth. So I think we do, we and the bank as a whole does have an experience of managing sort of a primary and a secondary objective, and the clue's in the name. The primary objective is clearly the thing we focus on the most and ensure that we don't sort of harm the secondary objective, or if we can enhance the secondary objective without causing anything negative for the primary objective, then we'll do so. But I do think this sort of the structure of having a primary and a secondary objective is something that we're used to and we are able to work with, and shouldn't necessarily harm financial stability.
Do you think there's a risk that you might find yourself in conflict, in sometimes find the two working in, against each other, where although your primary objective is financial stability, that you might, that might slip because there's this sort of, additional things that you need to think about, like competitiveness?
No, I think it will be okay. As John was saying, we're used to having a secondary objective. The other important thing to bear in mind here is that this secondary objective is being added in the context of us being given, if Parliament agrees, a lot more rulemaking powers. And I don't think it's unreasonable for the government to say, if there is a process which in a European context we used to input into directly and it's now being devolved down to you, you will need to take into account a bit more of growth and competitiveness than you would have done beforehand. I've always thought that was a reasonable proposition. But the nature of the objective as secondary is vital, because then it's very clear for us internally. It says we may not do things to promote the secondary objective which damage the primary. And that's such a pretty clear line. People who think it should be a primary worry that that means we can't do much. That's not true. We'll be able to do loads, but I think we'll be able to do it in a way that doesn't damage the primary.
Okay. And so, yeah.
2 points. The first one is, and it goes back to the point made on the call-in power, effective regulation adds to competitiveness, particularly when you're an international financial centre. I mean, I don't know.
Who's the call-in power? If they had understood it, would they?
I can't speak for the government. What I will say is that effective regulation does add to competitiveness. Good firms want to do business in well-regulated, and also centres that have robust legal systems. These are the things that underpin business. Yeah. The second thing is that we are particularly clear that one of the strong planks of competitiveness is international standards, where there are international standards. They don't exist everywhere. So the obvious case in point would be the Basel system. I mean, that is an international standard. It's a very strong international standard, well established, and abiding by those standards is part of competitiveness.
Sorry, just one final thing, which is, do you feel the government understands that clearly? The primary financial stability objective coming in the first order, followed by competitiveness, and this point about international standards. Is it? Do you feel in your negotiations and in your discussions with government, that they are very, very clear that you are, and you've said it in various fora, that they must not undercut international standards in the pursuit of competitiveness and giving you that secondary objective? Do you think they understand that?
No, they do. I really do think they do. I think they get a lot of other voices who say different things. Well, the industry. I mean, industry is, some parts of it, not all. I mean, by the way, look, I don't want to generalise about industry, because there are parts of industry that are very
senior managers regime is
very firm on the need for strong international standards, and then there are other parts that are less firm, frankly.
But
Thank you, Governor. I think what we heard you offer during Rushanara's questioning was that you were going to come back with an estimate of the increase in the probability that there might be a call on the public purse as a result of this package of changes. That's what I think I heard you say.
But I don't. I mean, let me just. I just want to be clear on the industry, because I don't want to paint them sort of in a bad place. You know, a lot of what they say is actually strongly aligned with us. But I'll give you an example, a current example on the Basel 3.1 programme. Now we've set out our consultation on it. It is very much aligned with the Basel Agreement. But we do hear some voices that say on one or two particular points that they would prefer the EU, what we think is the proposed EU version of the implementation of Basel 3.1. Well, the EU, and we had this experience when we were members of the EU, you know, under its previous implementation of the Basel 3.0 package is not compliant with Basel. It's sub-Basel. And you know, that's an example where you can get different voices, frankly.
But you have agreed to send us this analysis.
Yes, and we'll do our best to
that would be
not send something vast over, because it can get very long and very complicated.
That'd be helpful. Yeah. Alison.
I've got some questions around the UK's